I'm reading all the other people on the internet talking about this is it, the paper markets are breaking down and, all this jazz, that we're all waiting for and expecting to happen eventually. And I'm thinking, gosh, is that really what's happening? Because there was a day on the 11th of February where gold was up 5%.
Yeah.
And we hadn't seen that since like 2008.
Yeah.
I mean, it was remarkable.
Nearly 10 million ounces of gold resources through acquisition. This 50-cent stock has received a $2.65 price target from Cantor Fitzgerald. It's the one must-own precious metal stock according to New York Times bestselling author and fund manager Marin Katusa. Learn more at crushthestreet.com/gold2016.
Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Emenduri, and I'm joined today with Craig Hemke, a.k.a. Turd Ferguson of TFMetalsReport.com. And if you're looking for insightful updates on the economy, on precious metals, and more, this is the guy to follow. Craig is a returning guest. Craig Hemke, thanks for joining me today.
Ken, it's always a pleasure, and thank you for the kind words. I appreciate it.
Thanks for coming on the show, Craig. Well, Craig, you recently wrote a piece entitled The Door Slammed Shut, and I'd like you to further explain that title in a second here. But I need you to talk some sense into people watching these volatile markets. At the beginning of the year, markets were crashing and people were scared. And over the last week or so, we've seen an uptick in stocks, pushing them higher, calming people down. And now there's this I'll just call it a false peace feeling prevailing throughout. And I think the hardest part for long-term investors to do is actually sell. So if you wouldn't mind, please give us some historical background on what we've seen in the past in markets right before they have crashed. And are we seeing similar patterns today in 2016?
Well, we certainly are, Ken. And there's kind of two prongs to your question, and I'd like to address one of them first. And this might, for a lot of folks, come hear this and they react with a pretty bad case of normalcy bias or cognitive dissonance. And they can't believe that what I'm about to say is true, but I can assure you that it is. There is really no stock market, at least not in the sense that most people think there is. I mean, we're all taught and raised to think that the stock market is some interaction of human beings and they buy and sell equities based upon the fundamentals of that particular company, PE ratios, things like that, and how the overall economy is doing, how interest rates are doing relative to stocks, on kind of a risk-reward basis. And really, there's hardly any of that left. What drives the market on a daily basis are high-frequency trading computers. They are programmed with algorithms that follow a couple of key signals. Here in 2016, they've really been following crude oil quite a bit, which is odd. But primarily, they follow changes to one forex pair, and that's the US dollar in relation to the Japanese yen. Anyone, if you think that sounds silly, anyone can track this on a daily basis. You can go to sites like barchart.com or investing.com. Make your own charts, and you can see the S&P futures, again, the high-frequency trading computers that buy and sell these S&P futures, and you can see the futures tracking this dollar-yen pair. It goes by the symbol USD for US dollar, JPY for Japanese yen. You can see it tracking on a tick-for-tick basis. And so for folks that are, as you mentioned, either panicked or worried, and they wonder why the stock market goes down sharply one day and then back up the next, it's because these computers are following the dollar yen. It's why back on August 24th of last year, the stock market nearly crashed 2,000 or 3,000 points on the open. And it was all, again, due to that. And so anyway, the main thing is this notion that there are individuals making rational decisions to buy or sell based off fundamentals is just kind of arcane and naive at this point to think that's still the way the market operates.
So are you concerned about a market crash if the power really is in these computer algorithms and high-frequency traders?
Yes, that's the problem, Dan, and it's across all markets, is that there appears to be liquidity. There appears to be, all this volume. Oh, look at all the volume on the New York Stock Exchange. But when things move against them, these computers just step away, if you will. Now I'm kind of mixing metaphors and making them sound like they're human beings, but the liquidity dries up. That's why if you go back to August 24th, that's why the market opened up down 1,000 points, because the dollar yen had fallen out of bed overnight and all these computers were reprogramming to sell, sell, sell. And the only reason we only opened down 1,000 was because of all the individual circuit breakers that kicked in and all the individual equities and ETFs where, once they're down more than 5%, they halt trading. And so, yes, do you remember too the flash crash of 2010?
Yes, I do.
That was all related to high frequency trading. We've seen flash crashes and flash rallies in the treasury market. We've seen incredible volatility in really just about everything from crude oil down to gold and silver. And it's all because nearly everything is driven by a computer now with very little human input or interaction. And that's just a very dangerous place. And like I said, what this then does for the market, and when we talk about the signals that are there that the market is rolling over and preparing to crash, just like it did in 2001 and 2008, you have to keep in mind, though, that because the day-to-day movements of what we'll call it the stock market are so determined by changes to just simple things like that US dollar, Japanese yen Forex pair, it becomes really quite simple. If you're a central bank like the Bank of Japan, the Swiss National Bank, even the Fed, it becomes quite simple for them to actually influence the market to move in a certain way just simply by influencing that Forex pair. I mean, I know it sounds crazy, but when people say, how can the stock market be manipulated? I read all this stuff on Zero Hedge or whatever. That can't possibly be right because they have to buy $5 trillion worth of stocks. No, they don't. No, they don't. To get the computers to do the dirty work for them, something like the Bank of Japan just simply has to devalue the yen a little bit. And then that drives up the dollar yen, which forces all these computers to buy stocks. It's not a whole lot more complicated than that.
Well, you do a great job of articulating yourself and explaining this stuff. So I actually, in that same vein, I want to talk to you about how this relationship affects gold. And I know you've done some research on this, talking about the dynamic between the Fed, the PBOC, the US dollar to Japanese yen relationship, how it affects the stock market, how it affects gold. And if you could, could you further explain these relationships and, how it has benefited gold here in 2016?
Again, it gets back to this computer control more than anything else. From a stock market standpoint, if you remember I remember one day back in January, I turned on the news one night and the stock market was down rather significantly. It was because China was down. And they had George Will, of all people, trying to explain why the stock market shouldn't be going down. And I'm thinking, what the hell does George Will know about the stock market? Right? We're only, they're 17% of our trade. We shouldn't be affected by them and all this. And I'm like, you have no idea what you're talking about. Right. How this, in simplest terms, is just think of one domino falling into the other. The U.S. jawbones their way into trying to make it sound like we're raising rates back at the end of December. Right. Now, they did raise the Fed funds rate, but all the other rates from the 2-year note to the 10-year note to the 30-year long bond have gone down. So are there higher rates or not? But anyway, they do this talking and this symbolic action. That drives the U.S. dollar higher. Well, the Chinese yuan is pegged to the U.S. dollar. And so that, therefore, by definition, drags the Chinese yuan higher, which puts pressure on the Chinese economy, at least as they see it. So in January, especially in early January, we start getting this wave of devaluations of the yuan by the People's Bank of China. When they start doing that, that forces an unwind of a carry trade between the Chinese yuan and the Japanese yen. The unwinding of that causes the yen to rally, which forces the inverse, which is that dollar yen we talked about, to go down. And when the dollar yen goes down, the stock market goes down because these computers sell the stock market. That's why when you see trouble in China or China devaluing, that's how all of that was connected globally.
What is the Japanese yen to the what is the dynamic between the yuan and the Japanese yen? Why is there that relationship?
Whether it's just a simple carry trade of money managers that are selling one thing and buying another, or it's as simple as I like to explain it this way. It's as simple as, say you take a trip to Europe and you're going to take your family to Italy and France and all these places. When you get there, provided you're not just dealing with a credit card. You take your dollars, you sell your dollars, and you buy euro so that you can do your local transactions. You can buy stuff while you're there. Then when it's time to come home, you take your euro and you sell them and you buy your dollars and you go home, right?
Right.
Basically, think of that in a much larger picture. If you're in Japan, if that's your prevailing currency and you want to invest in China because of these, it's been growing like crazy, or at least appears to have been growing like crazy for the last several years. You take your yen, you sell your yen, which forces the yen down, and you buy Chinese yuan. Okay? And you do your investing. You buy stocks, you buy whatever you buy in China. But now when that is appearing to end and you want to get out of there because China's collapsing, too much debt, whatever, you now sell your yuan and buy your yen back, just like you're leaving the country. And that forces the yen higher, forces the dollar yen down, forces the stock market down.
I see. So, and it's because Japan is significant because they're a large economy that's right next to China that, is very impacted by them. But, could we see that relationship throughout a lot of other countries in that area, but it's just not as, material because they're not as significant of economies in that region?
Right. And as China devalues, there are other countries in that region that are then forced to devalue their currencies as well to stay competitive as they view it with China. And that strikes off this, Jim Rickards has always called it the currency wars, these competitive devaluations. And that's what has been driving and the key factor affecting all markets really, well, for quite some time, but particularly the last 6 months. But that's really what's been driving the stock market so far this year.
So,
go ahead. I'm sorry.
I'm
Ken.
sorry. I thought I didn't mean to cut you off there, but I was just going to ask you about gold. So we've seen gold act pretty bullish this year. So I wanted to ask you, what are further bullish confirmations that we would need to see in the short term that would confirm this bull market to the upside in this 2016 year?
Well, I'm going to sound like a broken record, Ken, but I have been actively trying to warn, educate anybody on my site, all of my subscribers, that this current move, all of that which took place in February, is primarily driven by the computers as well. And we can go back and look, and you can go to those same sites I mentioned, and you can plot, unfortunately, the price of gold with the yen as well. And you can see how they've tracked each other for the last 3.5 years, really since gold. If you remember back at the institution of QE3, back in October of 2012, gold was about $1,800. And everybody thought, hey, wow, this is really going to soar from here. I know I did. And instead, even though the monetary base continued to rise, the federal debt continued to rise, all of a sudden, where gold had been tracking that for years, suddenly gold diverged and plummeted sharply. And if you pull it up at the same time, the yen was plummeting sharply.
Wow.
And so clearly the high frequency trading computers and whoever runs them, and that's probably a topic for another day, have paired gold with the yen. Again, here's the same computer driven market, paper market. And so I'm sitting there one day, this was now back in early February when things were really taking off in gold. Remember, we went from 1,100 through 1,200, all the way by February the 11th hitting 1,263.
Right.
And I'm watching this, and I'm reading all this stuff, and I'm trying not to get overexcited myself. And I'm reading all the other people on the internet talking about, this is it, the paper markets are breaking down, and, all this jazz, that we're all waiting for and expecting to happen eventually. And I'm thinking, gosh, is that really what's happening? Because there was a day on the 11th of February where gold was up 5%.
Yeah.
And we hadn't seen that since like 2008.
Yeah.
I mean, it was remarkable that happened. And I thought, here's the problem. At the same time as that, there was an historic drop in that dollar yen that we talked about. Early in February, you'll recall, the Bank of Japan announced one, morning in Japan, evening here in the U.S., that they were instituting negative interest rates. Remember that? Instantly drove, that's a devaluing of the yen, made the yen weaker, made that dollar yen go up. That's the inverse. And it went up by 3 points in 5 minutes. And everybody thought, oh boy, here we go. Well, that move didn't last. I even wrote something shortly thereafter about this is the ultimate failure of confidence in central banks. And that dollar yen went from 121 down to 111 in 10 days. That's a 10% move in 10 days. And it coincided perfectly with gold rallying in early February over the same time period.
Yeah, wow.
Again, because these computers, they see the falling dollar yen, the rising yen, and they buy gold. And it's this computer-driven paper trade. And so what dawned on me after watching that on the 11th, over Valentine's Day weekend, I sat back and I took it all in. I thought, this isn't anything to be excited about. This is just the same old stuff. This is just, we had this historic move in the yen, which causes historic pop in gold. Now, on the positive side, it did some real technical damage, if you will, to the bank position, in that in the gold price rising as much as it did, it burst through the 50-day moving average. It burst through the 100. It burst through the 200-day. The rise has extended so far that now the 50-day moving average has bullishly crossed up and through the 100-day. It's bullishly crossed up and through the 200-day. And so there's a very positive technical setup, which is making it difficult for gold to fall back down. Have you noticed how resilient it's been for the last couple of weeks around this 12? Yeah. Even when it begins to sell off, like yesterday, it gets down to 12.25, it bounces right back up. That's again because these computers, other computers, not just the ones that follow the Forex pairs, other ones that are set to follow technical signals, you think of it as like a switch being flipped. When the moving averages are set the way they are, positively like they are at present, these technical funds are more apt to buy the dips rather than sell any rally.
Wow.
And they've been selling rallies like crazy, for the last couple of years. And so anyway, the gold had this rally so far this year primarily because of that huge move in the yen back in early February. But now it's consolidating and hanging in there. And we'll just have to see if it can somehow maneuver higher. The big banks, JP Morgan, HSBC, these bullion banks which control and make the paper markets in New York, they haven't changed their behavior at all. They have been creating brand new naked short contracts to feed to the speculator demand. They've been doing it like crazy for the last month. They've naked created almost 350 metric tons of new paper gold to meet the demand. So their positions haven't changed. Their behavior hasn't changed. I think it's logical to expect these banks to try to use some event, maybe this Friday's employment report, maybe it's the FOMC meeting in 2 weeks, to try to use some event to tip the market, paper market back over, drive the speculators back out, and attempt to cover some of that paper.
Craig, you're anticipating my questions.
Okay, fair enough. I'm sorry. I tell you, Kenny, it's funny. Sometimes I do interviews like this. I do these podcasts every day for my subscribers, like 20, 25 minutes of just nonstop free flow thought. So I apologize. Sometimes I've gotten in such a habit of talking for 25 minutes at a time that sometimes
I actually do understand. But no, I wanted to stop right there.
Okay.
Central bank manipulation and the evidence and what we've seen. You talked about it. You touched on what they're trying to do. So watching gold go higher here in February, was that a sign of them losing control of precious metals? And, you talked about that 5% move, which was roughly $50 back, a month ago or so.
February 11th.
That doesn't happen very often. I mean, and could we see much larger moves going forward if central banks do lose control here in the who knows when?
And this is where fundamentals may finally begin to play a factor, because we that study the gold market have long thought, it's so over leveraged. Nobody even knows how much actual physical gold with clear title is left in the West, because all the central bank gold's been leased out and loaned out. There's all these unallocated accounts. There's the shares of the GLD. There's the futures contracts, and all these people that think they own gold, that they don't own gold. They own just a paper obligation that somebody else is going to have the title to it. And push comes to shove and the music stops, you don't got nothing. And so we've all thought that the key then to maintaining this confidence scheme of paper markets is the actual physical delivery. And with China and Russia and India and all these points east just continuing to soak up more gold every year than what is being mined, it makes you think that eventually the West is going to run out and this confidence scheme will fail. I've maintained that the key to keeping it going has been this long suppression, keeping the price down, so that in the West, the investment demand will remain low, because we like to buy things that are going up, and gold's just a pet rock and all that kind of stuff, right?
Yep.
So having gold rally now is increasing investment demand. I don't really think they've put 140 actual metric tons of gold into the GLD so far this year, but that's still 140 metric tons of demand, if you will.
Right.
And that could really, if price begins to accelerate and there's more and more Western demand, it really does begin to accelerate the demise of this confidence scheme that the bullion banks run. So that is a positive sign.
Craig, so you talked about high-frequency trading and automatic triggers that buy and sell markets and manipulate things. Now, I kind of want to get your thoughts on when you think, to a larger extent, the big money is going to enter the precious metals market. And if you think there's, a price that will trigger this big money to enter this precious metal sector to a larger extent and put this precious metal sector into a full-fledged bull market?
Well, the first thing is the technical factors. If we can continue to make some higher highs, that's one of the things that this yen-induced rally in January and February did, is we hadn't made a higher high on the gold chart really since price broke down 3 years ago. But when we got through 1190 and then got through 1230, we did. So that's one thing that sets the chart looking positively. We talked about the crossing of the moving averages. That type of thing helps to continue to spark interest from the institutional community, even in paper contracts. And we've got to have more and more paper buyers to keep pushing the paper market higher, because if the paper buyers flatten out or turn into paper sellers, it doesn't matter what the fundamentals are. Paper price is going down.
Yeah.
So that's critical. But at the end of the day, what really is going to matter is the acquisition of physical metal. There needs to be an education process, and there needs to be, frankly, I don't know if it's a level of fear or fright to get people to actually say, oh, no, I don't want any of that GLD. I understand that's just kind of a shell game. I want the real thing.
Wow.
And if institutions, if hedge funds, pension funds, whatever, if all of a sudden they start demanding the real thing, unencumbered, clear title, hold it in my hands, put it in my safe, real thing, that's when it'll get really, really interesting. And the price that's discovered in a true physical market isn't going to be $1,200 an ounce.
Do you think there's a paper price that will kind of trigger that flood of buying, say, $1,400, $1,500, and kind of that confirmation for them to want the physical and to kind of send this into a full force bull market?
That's hard to say, Ken. The first thing I would say, I've got a chart I've been posting that shows the last 3 years of price action, ever since we were ruthlessly driven lower in April of 2013. Remember, price had been above 1525 as a floor for about a year and a half. And then on April 12th and 15th of 2013, it was smashed like $200 lower in 2 days. Ever since that happened, we've been in this sustained downtrend with all these lower highs. The rally to 1263 on February the 11th, 1263 was exactly right up to the trend line off of that move down. And so first and foremost, is there a price that could spark new momentum to the upside? Yeah, a new high here would be a really big thing to get above 1263, especially on a closing basis. It may take, I don't know if a real lousy employment number would do it Friday. When we get the FOMC meeting 2 weeks from now, basically 2 Wednesday from today, Wednesday will be the headlines at 2 o'clock out of the FOMC. If there's no rate hike, if there's some dovishness, whatever, that might propel gold up there. That would be the first thing. We need to continue making higher highs, and people really get people's attention is that old 1525 level. That's a long ways away from here, but 1525 is where we broke down in September of 2011 after breaking down from 1900, and again that held as a floor until April of 2013. If we could ever crawl back above there on, say, a weekly basis, oh man, it'd be pedal to the metal at that point.
Yeah, that makes a lot of sense, and that's kind of what I've been, waiting for. I didn't have a number in my head, but I can only imagine what the market is going to, how the market will react when we do kind of have all these confirmations that gold is going higher. So Craig, I wanted to transition and get your thoughts on silver, because to be honest with you, it's been somewhat of a disappointment when compared to gold, and psychologically seeing it under $15 at the moment. We're doing this interview on March 2nd. Silver's at $14.94 on my screen, and it's been a bit beat down, although it is up today slightly. Mm-hmm. So what's the story with silver at the moment, and why is it underperforming gold?
This is really easy to explain to folks, but it's something, again, that people have to understand how the paper market works. It's not a reflection of physical silver demand. We had huge numbers, record numbers in February it's just anecdotal evidence, but out of the U.S. Mint, right? Huge, biggest February sales ever. So it's not, the price of paper silver doesn't have anything to do with the physical demand. It has to do with the trading of these paper contracts. And it's a tiny little paper market dominated by JP Morgan and a couple of other banks trading against, a handful of 30 or 40 big hedge funds. And you can see all of this on the data that's cranked out by the CFTC every Friday with their Commitment of Traders report. The reason why silver hasn't kept up with gold is because there has been a huge movement made by JP Morgan and these other banks in silver to essentially cap the price. They have been issuing new contracts, selling short versus speculator longs, and they have increased think of it as a combined net position. You've got JP Morgan, HSBC, Scotiabank, and a handful of others that are the market makers that issue all these contracts to the speculators on the COMEX. Mm-hmm. The combined net position of those 7 or 8 banks is the largest net short position since 2008.
Wow.
They've driven it up just in this little itty bitty move from 14 to 16. They drove it from being about 30,000 net short at the end of last year to currently being, at least as of last Friday, 74,000 contracts net short. Now you can say, okay, what are they afraid of? Because this isn't a bunch of miners all of a sudden selling forward a couple years worth of supply. That's not what this is. This is just these banks defending their existing short positions. Now, you can make it as complicated as saying, well, they're manipulating the market, and they are. But I think they're also doing it to what the point I just said, defending their existing position. Ted Butler analyzes this stuff on a weekly basis, and he pegs JP Morgan alone, JP Morgan's short position at about 30,000 silver contracts on the COMEX. Now that's not to say they don't have other long positions someplace else. But if you're the guy that's just simply in charge of that 30,000 contract short position, every dollar that the price of silver moves up against you costs you on paper $150 million.
Wow.
Okay, so if silver were allowed to run free, if the banks weren't sitting on it, and let's just say silver went from 15 to 20, that's $750 million in paper losses to that massive short position that JP Morgan holds. And so they're just simply defending it with all they can. And that's the important thing for people to realize. And it pertains to gold as well, is that for now, these banks are still in control. And they just continue to issue these shorts and sit on price, waiting for the day when suddenly the news turns bearish or negative for gold. And again, whether that's the employment report this Friday, or maybe it'll be the FOMC meeting in 2 weeks. And all of a sudden, all these speculators have been buying, all head for the exits at once. And you get this downdraft, and we've seen it, goodness, how many countless times, right?
Yeah.
And that's what JP Morgan's waiting on again. And they've sat on price. Boy, you can pull up a daily chart, and ever since that high of $15.99 on the 11th of February, it has just been a steady shove lower. And it is exclusively, entirely due to the big banks, JP Morgan and their friends, sitting on price, protecting their short positions. Now, one day, will it fail? We're all waiting for that day. But what people need to understand is, for now, they are still firmly in control. At this point, I think you almost have to expect silver to wash out further, maybe back down to at least 1460. if not 1440, maybe even 14. But the level around 14 has been pretty consistent support for well over a year. If we get down there again, it'd probably be another opportunity to start building long positions again. But the key to understand, that's why. Everyone's like, why isn't silver keeping up? Gosh, the fundamentals are so good. It's a little tiny market, and this handful of banks absolutely and utterly control it. And that's why it hasn't gone anywhere.
Craig Hemke, everybody, of the TFMetalsReport.com. Craig, can you share any of your latest updates or information that you'd like to just share with our audience about your website and what you got going on?
We talk about a lot of stuff at the website. The kind of the mission statement, if you will, is preparing for the end of the great Keynesian experiment, this debt-fueled, whatever you want to call it, society that we live in, experiment, idea, is all kind of moving toward its mathematical end, and it has been now for several years. It's obviously taken a little longer than we might have thought, but the numbers haven't changed. And we've got a big, large group of subscribers and other people that use the site. We're all in the same boat. We're all trying to help each other prepare. So it's a very friendly site. And I encourage people to check it out. For the inside baseball stuff, a subscription to the other stuff that I do, the podcasts and the daily reports, is a whopping $10 a month. So we're talking, a couple cups of coffee, but I get good feedback. People tell me it's well worth it. And so I encourage everybody to check it out. Absolutely.
Craig, you're one of the most insightful guests that we have on the show. So I really do appreciate you coming on and speaking with us today.
Ken, it's my pleasure. Anytime.